Isn't
That
that
is the best thing you can do as a rich person, to have a friend who has a jet versus having your own jet. And I have so many friends who have jets, and then they complain, be like, man, my microwave went out on my jet. It cost me $30,000 or $40,000 to replace this stupid thing. Or like, oh, I'm stuck in O'Hare and it's really snowing, and they charge me like 20 grand to defrost my plane, or like something like that. Like those kind of things would just really irk me, and I just can't do it.
You're making these smaller investments. You had a friend, you said, hey, just create a fund. I'll make a bigger investment. Now you're kind of in the middle of this evolution, and
Yes.
you get a little older, into your 30s, you're more mature, you're married, starting a family, all this stuff. And now, you mentioned your income numbers. Now you're generating a lot of income, and it's like investing the income and recycling it as investments come to fruition and liquidate. At what point did you say, you know what, I really need a family office? I need something more structured to just manage our family wealth, our legacy wealth, our generational wealth?
Yeah, so it was never a moment where I thought like, hey, I need to actually create a family office. And I don't really consider it a family office, even though you can say it's fractional. It was more so, hey, I need help, and I need people to help me with some of these tasks, like the taxes. And there was some legal stuff, and I have tons of trust and grantor trust and dynasty trust. And like, it's just all starting to add up. And then it just becomes a real headache from a management perspective.
Yeah.
And then my wife manages our philanthropic arm. And there's not really an arm. I call it a tear factor. Me and my friends, we joke around. We call it a tear factor. The more my wife cries, the more she donates, based on the foundation pitching her. And I'm very logical. Like there's food banks and all this kind of stuff. And my wife focuses on a lot of like things for children, like education, poverty, and all that kind of stuff. And I'm more like, well, we're funding this program to help fight poverty for children. What were the stats and the data on how many less children went hungry because of our donations and all the donations they got? And my wife more looks at it as like, well, you can't think like that, like they're making like a.
Well, Neil, my
like
experience, you need, okay, in a family office, this is actually a discussion I had with Danny Roisman, who manages a family office for a lot of ultra high net worth investors. You kind of need both in a family office, the right brain and the left brain, and managing the money. And then to your point, the philanthropic arm, you need the more creative and human-centered, heart-centered stuff, because that's the heartbeat of a family. Families don't run on dollars and cents, or even logic. Like, let's be honest, Neil, families don't run on logic, right? But at the same time, you're an entrepreneur, you're numbers focused, you're very logical. I mean, obviously you're a super intelligent guy, but my point is, like, it's not good or bad or better or worse. You kind of need a system or way to organize it all, and kind of get it all running and humming. Into that, you need external help, right? And you said you don't consider it a family office. It might be a multifamily office or shared family office or whatever. I might call it a family office just because it's a better podcast title. But so you kind of mentioned you and your wife, you kind of have different roles, which is good, right? Complementarity. What kind of external help or what kind of structure do you use to kind of help guide you and to cut down on the headaches? Can I call them headaches involved with all this?
I call them we have a team. Let's just say there's one person that I talk to who deals with everything, right? And he deals with the headache. And then from there, he hires people and deals with everything from lawyers to accountants to people who deal with trust to people who are analyzing some investments like stocks and keep, our angel investments, things like that. Although I don't really deal well with people who are giving me angel deals or private equity deals. I like more so doing them myself and being involved in that. I don't like dealing with a lot of the mundane stuff or dealing with stocks, although I will do some of my own trades. Like I called up one of my guys and I'm like, what do you think about First Republic? And this is when all the banks were crashing. And I remember the weekend right then and there, it was the government said we're going to backstop some of these stocks, like or the banks. They were going to backstop SVB, and I forgot. I think there was one other that were going under. They're like, look, don't worry, you guys won't have to worry about your money. At that point, I was like, all right, the government's going to bail out these banks. And then JP Morgan did a deal with First Republic right then and there on the weekend announced. So I'm like, well, they don't need the money if the government is going to create this program that's going to give people the money in case they're short for some time and they don't have to liquidate, let's say, their treasury or whatever it may be. So then in the morning, right when I wake up, I could already see the stocks, and a lot of the bank stocks are just tanking. First Republic was getting hit one of the hardest. So then I remember right when the market opened, I was like, a few minutes were going to buy, it kept going lower and lower. And I remember it hit around 18 or 19 or something like that. And calling one of my guys, I was like, what do you think about buying some First Republic? And I'm not too risky. I won't do tons of options and stuff like that. And I was just like, I think people are overreacting. I'm not saying the company is actually worth 19 or 30 or whatever. It was $100 company before. I'm not even saying it was worth 5, but I'm like, it's just all going down based on emotion. Mm-hmm. And I was like, once people realize, like the consumer, that they don't need to go to all these banks and start pulling out their money, I believe that the market would rally, just because a lot of it is sentiment, right? No one knows the financials of First Republic at the time. They're just reacting. And
like a bank run. It's the beginnings.
Yeah, exactly. Yeah. So then I tried buying $3 million worth of shares at 19. I think I got a little bit under 900 grand got filled. And then the price, when I started, it kept going up, and I was too cheap to pay.
You were probably moving the market. I mean, I don't know if that amount of money.
I don't think I was moving the market. Only $3 million worth of shares is a lot. So I was just like, I was clicking buttons, and I was just buying myself. And then at 19.5, I was like, oh, I can. Then I was like, oh, I think this thing's going to go up. So then I increased, it started going to like 19.85 or 83. And I was trying to buy it at 19.8. I was penny pinching, and I shouldn't. And I didn't get any more of a fill. And then I didn't sell it that day. The next day I sold it. I think I made it like around 1.4. I would have been happy if I got $3 million worth. And I could have bought more, but I also didn't want to buy too much of it, because if I lost $2-3 million worth, it's not the end of the day. And I was willing to take the loss. And I believed I was going to make something. How much, I didn't know. But like 1.4 in 24 hours, right? Sold it the next day. And I think it was going to like 50, cash out, and then it started going down. And I'm like, let me just sell this thing. I'm up enough. And I didn't buy any more after, even when I kept going down lower, and then it went back up. Because at that time, people are starting to trade. They're getting more data and all these financials. Maybe they're not releasing financials, but people are doing their own back of the napkin math on like, hey, what's happening? How much of their money is in treasuries or whatever? And people are trying to do their own calculations. I traded purely on emotions, not my emotions, but I knew the market was illogical on their trading on the first day. And I knew that you're going to see crazy roller coasters. I was like, there's an opportunity to day trade here. And I took it. And I didn't get too greedy. I could have made more money. But it was a good enough
So I hear you. You're opportunistic. I mean, you're an entrepreneur, you're an investor. You love technology, but you love ideas. You love, the game. We could call it the game. And now I would call it a family office. You have a manager who's delegating tasks to other experts. So you're interfacing with him. So he's taking a lot of this.
But we split some of the costs, right, with other rich individuals, right? That's why I call it multifamily office. But
sure. So it's a shared family office or multifamily office. So who may I add? You don't, obviously I'm not asking for their names, but are these other individuals that through business that you decided to do this together, or how did that process start?
Yeah. So the guy who I have helping me run a lot of stuff, he was a finance guy, and he did really well managing other people's money, and started working with him.
Okay. And
so he has, and this is what he was pretty much doing in the past, right? So he did it both for himself, in which raising funds and deploying it. And then eventually he went into the family office route, in which he was just like, hey, I'm going to just work with a lot of the rich families I met. And then, said, all right, let's work together. And that's how it got set up. because he's like,
Got
hey,
it.
how about I alleviate some of your pain? At first, it wasn't called a family office. He's like, how about I alleviate some of your pain? It was a business model for him. He
Mhm.
was like, hey, I'm going to create this and make some money by charging some rich families. He's like, how about I alleviate some of your pain? And then it just kept growing. And then he pretty much was just like, yeah, I have a service. If you want a fractional family office, that's what he offers.
So, how is your experience? It is working with this multifamily office, and it sounds like your assets and you are a big part of it. Um, has it freed up a lot of time for you? I mean, has it
It
improved?
has. It doesn't make a ton of money. I'll be quite honest. I have better luck picking on my own than going with money managers. There's a saying I always that one of my buddies told me a long, long time ago. If you work with money managers and wealth advisors, they won't make you rich. They help you stay rich,
Mhm.
right? So none of these guys get the returns that I want. That's why I still do some of my own trades, and that's why I'm pretty aggressive.
But Neil, family offices, I mean, this is known. They're focused on capital preservation. You're totally correct because a family office manager, the downside is way worse for you than the upside is good, in the sense that if you make 12% returns versus 9%, yeah, your client's going to be happier, but they're going to be happy if you make 9%.
Hopefully 9% returns a year, by the way. What they keep trying to remind me is, Neil, if you lost all your money, how sad would you be? I'm like, yeah, I would be bummed out. My life would really suck. And they're like, if we got you 7% returns, 5 to 7, and we're clocking way better than that. They're like, how much better would your life be if it's 5 to 7 versus 12 or 20? There's no difference in lifestyle from flying back and buy a jet. Like, there's no difference in lifestyle. Now, there's certain things I can't do. Like, I can't just go keep burning money on, like, I can't just say, hey, let me go buy $100 million house here, $50 million house there, plane there. Like, I'm gonna go broke, right? Like, there is a limit to how much money I have, because I have a good amount of cash, but most of my net worth is still tied up in my corporations.
Mm-hmm.
If I sold them, sure, I can start buying bigger purchases, like $100 million house there, 50 somewhere else, or jet and all that kind of stuff. But for
You don't
me,
want a jet, Neil. Nobody really wants a jet. The goal is you ride on other people's jets. Isn't
that
that
is that
better?
is the best thing you can do as a rich person, to have a friend who has a jet versus having your own jet. And I have so many friends who have jets, and then they complain, being like, "Man, my microwave went out on my jet. It cost me $30,000 or $40,000 to replace this stupid thing." Or like, "Oh, I'm stuck in O'Hare and it's really snowing, and they charge me like 20 grand to defrost my plane," or like something like that. Like, those kind of things would just really irk me, and I
Mm.
just can't do it.
So
And even
you're kind of a minimalist. I mean, in your own way. I know you live a night.
minus the real estate, minus the real estate. Like, still have a Honda Odyssey for a family car, drive that around. My wife has a nicer car than me.
Yeah, I was
Uh,
gonna say, Neil, we got to get you a Bentley or Ferrari or something. Come on, have a
my
live a
wife has a
little.
Bentley. I
Okay.
have a Maybach. I have a driver. I don't use them that often, but when I go to meetings, because I have a laptop table in the back, Maybach just looks like a normal Mercedes. It's just a little bit longer. I have my iPad with Wi-Fi or cell signal, and I just work in the back, instead of dealing with traffic. I don't use that often, but maybe like 5, 6 times a week. But to me, that was worth it because I work too much, and when I drive, I get into too many car accidents, or I did when I was younger. So I tend not to drive too often. Just more so mentally tormented by driving. Not that I'm probably a decent driver, but
I
still
get
I
it.
just too paranoid. And yeah, like I am a minimalist to some extent, and I still want the returns. So I just keep going and going. And when I look at all these money managers, they're like, I look at their stock returns versus my stock returns, buy like HubSpot in the early days, and Shopify and Google and Amazon, and some of those not too early because I'm not that old, but buying them early enough and just holding. I'm like, well, my returns are better than your guys, and you guys try to do all these complex things and try trading or just buying the S&P. I'm like, I just buy companies like Apple that I believe in and I hold because I understand technology. And my biggest diversification into non-tech for money I manage personally, right? Not talking about the family office, but I manage personally. My only outside investment outside of tech was Disney because they got into streaming, and eventually I ended up selling the Disney stock. But I'm all in tech. Some of my other guys do non-tech, and I took a beating last year. And they're like, see, this is why. But if I look at my average returns from when I got in, I'm crushing all these money managers. I'm not saying like I'm better trader than Ray
Yeah,
Dalio or anything. I have a small amount of money versus some of these guys are dealing with like 100+ billion, but just buying Apple stock back in the early days gives you amazing return, or HubSpot stock. I don't really look at what did they do this quarter. I'm like, believe in the operators, believe in the business model, buy, don't look. And 10 years from now, you'll see what the stock's at.
totally. And Neil, one thing I love, everything you're saying is just you love the game. I mean, I can tell that you kind of this passion that you have for entrepreneurship, you have that same passion for your investing, and it's almost an entrepreneurial attitude to your investing too. It's you kind of know what you know what you're passionate about, technology, marketing, software, these sorts of things. And you're not in the game to amass as many yachts or private jets or whatever
No,
as possible. I
we're going to end up donating almost all of it. We have money in trust for our children. It is blind. I think they call it blind trust, or they don't know about it, whatever you want to call it. I think it's blind. One's a grantor trust, one's a dynasty trust. The money's only there like, hey, if you got cancer and you can't pay for a treatment, gladly pay for it. If you're on the street and you have no roof over your head, we'll gladly help you out. But if you have a job, you can figure it out on your own. Or
Mhm.
if you want to be a doctor and volunteer all your time in Africa and just help people in like these third world countries that have no money and no health system that's that great, and you need money to survive, but you want to volunteer all the time, I will pay for your life in a normal
So,
life,
so
right?
Neil, what you're talking about, and so this is another, I think, common theme with family offices is you're figuring out, maybe you have figured out how you transmit your values to the next generation, right? Because that can be a challenge for ultra high net worth investors, ultra high net worth families, is you didn't start, with a Maybach and a driver when you were 17 or however old you were when I met you, right? You had incredible work ethic and drive to succeed in life, and you want to make sure to pass on that value to your children. And sometimes giving them too much wealth too early or with the wrong structure can actually impede your ability to pass on your values, right?
Yeah, and for us, we believe they don't need it. Like if our kids want to buy a Ferrari, I don't care what place you are in life, you figure it out on your own. Or if you want to go take a vacation to Italy, go figure it out on your own. Now, if they're with me, I will gladly do it. Or another bias thing I have when it comes to wealth is, we probably will retire in, we're from Southern California or Los Angeles, technically Orange County, but it's close enough to Los Angeles. So we have a home in Beverly Hills, and not a crazy fancy like $100 million home or anything like that, but it's expensive enough and nice enough. And let's say, my kids, if I'm getting older and I can get them to live next to me, but they can't afford a house in Beverly Hills, I would gladly buy the house next door to me if my kids live next to me and I get to see them grow up and their kids and
Sure.
all that kind of stuff. So for certain things, I'll make a sacrifice, but it's like for me, it's just like if I'm gonna live my life, I want to enjoy it and not enjoy it from like going on a yacht. I don't care for yachts or like even private aviation. Like I was going to New York. I could afford a private flight, but one of my buddies is raising money for kids in New Jersey for inner city, like a lot of the young kids there and even their parents, they don't even have money for things like toilet paper or feminine products. And, give them 100 grand check. I'd rather spend the 100 grand doing that and go fly on JetBlue, lay flat, which cost me maybe 1,000, 2,000 bucks, and donate the money than, have a convenience of saving a few hours and being in the private aviation, right? Like
Yeah.
the money I just believe is just being wasted and is also not the best for the environment. But yeah, I don't believe future generations of my kids need the money. I believe it's better to just donate everything.
So you've set up your family office, around your values, which makes sense. And I think that's the goal of every family office, is to have that mission oriented and values oriented outlook. I know we're short on time, Neil, but kind of to zoom out a little bit and to think about, you have a very inspiring life story as an entrepreneur and kind of your journey where, you built up these successful businesses and leading to this shared family office. What is there any lesson or tips that you could give entrepreneurs that are more toward, that they're more like the 20, 21, 22-year-old Neil Patel, just getting started. Their businesses are beginning to be successful. They're beginning to write those checks to angel investments or private equity funds or private real estate funds. What advice do you give them to get to that next level of success?
So there was a wise man in Seattle that gave me this feedback when I was first starting off. And he said, Neil, you don't need to figure this out. He's much older than me. His name is John. I'm not going to say his last name. And he invested in some telecoms and a few other things. And he told me, and at the time when he's giving me this advice, he was in his late 50s and I was in my early 20s. And he's like, Neil, if you want to succeed in life, you already know a lot of successful people. Just ride our coattails. So, and he didn't mean it in a bad way to like
Yeah,
leech or not provide value, but he was saying, if you know other successful people and your friends, ask them, ask them to include you in their deals. You'll learn along the way by just co-writing checks and you'll avoid a lot of the mistakes because they've been through this many times. And that's how I started. And it was a great lesson for me. And it helped me avoid a lot of mistakes. And it also helped me produce better returns.
I love that, Neil. I think that's a great note to end on. I really appreciate you sharing your story of entrepreneurial success, but also your investing mindset. You've been so transparent about your process. I always love when a guest is honest. It's rare for us to have someone, to share that whole story from the beginning all the way to the current day, how you manage your family office. So thanks again for joining the show today, Neil.
Sounds good. Thanks for having me.